Welcome back to The Explainer. Today, we are getting incredibly precise. You've done the hard work, you've found those absolutely stellar companies out there, but the million-dollar question is, when exactly do you hit that buy button? Let's dive right in and master market entry. We're going to decode a couple of absolutely crucial chart patterns and learn how to dodge a massive trap that literally crushes beginner portfolios. Okay, let's dive into this by doing just a super quick recap of our last explainer. We talked about the dual screen method, right? Remember that left side fundamental screen? That's the one that tells us the what to buy. We're talking stellar earnings, growing sales, that rock solid balance sheet. But the right side technical screen, well, that tells us the when. You absolutely need that green light where the price is trading confidently above both the 50-day and 200-day moving averages. Look, if you don't have that confirmed uptrend, you just don't have a trade. It's really that simple. So the exact moment to strike during a confirmed uptrend? You'll often find it in a pattern called the cup with handle. It's a classic bullish continuation pattern. Just imagine a stock that's already in a great uptrend, but it needs to take a little breather. It dips and then recovers in this nice rounded U shape. That's your cup. Then it dips just a tiny bit one last time. That's the handle. And honestly, that handle is just a final shakeout of all the nervous investors. Your absolute optimal entry point is exactly as the price breaks out above that handle's resistance line. On the flip side, you really need to know when to run the other way. Let's contrast that cup with handle with a totally different beast, the head and shoulders pattern. Guys, this is a stark, glaring warning that a major trend reversal is underway. Basically, you'll see three distinct peaks. The middle peak is the highest, that's the head, and it's flanked by two lower shoulders. When the price actually breaks down below the neckline, that invisible line connecting the bottoms of those peaks, well, the bull run is officially over. The trend is broken. It's time to play defense and protect your capital. But listen closely, because here is the most important secret to reading any of these patterns. Volume is the lie detector for any chart pattern. I really mean it. If you see a cup with handle breakout, but the trading volume is super light, it's a lie. It's a weak, totally unconfirmed lie. See, real institutional buying, we're talking the massive mutual funds, the pension funds, that shows up as a huge, undeniable surge in volume. No volume confirmation means there's literally no real conviction behind the breakout. Do not take the bait. All right, moving on to the fundamental trap, the referee's decision. To really wrap your head around this trap, I want you to think of yourself as a referee on a football field. Before any play can actually count, you need two flags raised. You absolutely need the green fundamental flag, meaning yes, the company is financially stellar, and you need the green technical flag, meaning the stock is in a confirmed healthy uptrend. If either of those flags is red, blow the whistle. It's a no trade, full stop. And this brilliantly illustrates exactly what happens when you decide to ignore the referee. Let's just look back at the 2022 bear market for a second. Throughout that entire year, there were fundamentally flawed companies out there posting absolute record numbers. Yet, they were technically broken. They were trading well below both their 50-day and 200-day moving averages. Why? Because the market was already pricing in future macroeconomic pain that the current balance sheets just couldn't see yet. It wasn't actually until 2023 that price action finally confirmed a new uptrend. Look, if you bought in 2022 simply because the company was a quote-unquote good business, you sat through an entire year of agonizing losses. Let's stop right here and put your new skills to the test with a quick real-world quiz. Picture this scenario. You've got a company showing record earnings per share growth and surging sales. Honestly, it looks completely perfect on paper. But the stock is currently trading below a downward-sloping 200-day moving average. Take a second and think about it. Do you hit that buy button? Is this the exact trap so many beginners fall for? Wait, don't buy. If you said no, absolutely fantastic job. You just avoided the fundamental trap in real time. Even though the fundamentals pass with flying colors, the technicals pale, meaning the broader trend that stock is caught up in is still working aggressively against it. The market is sniffing out something that you don't know yet. You absolutely must wait for technical confirmation before you risk a single dollar of your hard-earned money. So the crucial point is, you now have this incredibly powerful, complete entry arsenal right at your disposal to pick the right stock at exactly the right time. You've mastered the dual screen method to make sure you're only picking strong businesses and strong trends. You know exactly how to spot the cup with handle for those precision entries and the head and shoulders when it's time to heed a reversal warning. You know volume is your ultimate lie detector to confirm real institutional buying. And best of all, you know exactly how to reject the fundamental trap. Okay, so you know how to pick a winning stock, and you know exactly the right time to buy it. But here is the massive portfolio saving question I want to leave you with. How are you going to make absolutely sure that one bad pick, or one bad sector, or even just one single awful day in the market doesn't wipe out everything you've just built? Next time on The Explainer, we're shifting gears entirely to defense. We're going to unpack the 5 risk types to protect all that capital you're about to deploy. You definitely won't want to miss it.